the next decade is going to belong to stock pickers. I don't care if that's technology companies, growth companies, industrials, financials, all of those have reasons to pick stocks and not the index. And the indexes will not outperform selecting stocks, and the ability to identify, do research, select companies that are well positioned and have valuations that are attractive. That is something that can be done today. And there are fewer people doing that.
Hi, everyone. It's a great pleasure to be here today with Bob Robotti. Bob is the president and chief investment officer of Robotti & Company, and he's beaten the market by an enormous margin over the last 40 years. It's great to see you, Bob. Thanks so much for joining us.
Thanks so much for having me here, and it's so good to be seen.
Great to see you. I wanted to start by chatting with you about your childhood in Queens in New York City. And I know you were born in 1953 and you grew up with two older sisters and a younger brother. And I read somewhere that you lived in an apartment above a dry goods store called Robotti's Department Store that your grandmother had operated. And that then later, I think when you were about one, your father, Edward, launched a property and casualty insurance brokerage firm also out of your home. And so I wanted to get a sense of what it was like growing up in that kind of environment where you really were surrounded by business.
Well, it's more modest than that. My grandfather did own the building. We owned the building, and the store was downstairs. We lived upstairs, and the department store didn't do a lot of business because it had been put out of business. If people in the neighborhood wanted to go to Macy's, it was easy enough to get in the subway and go. So back decades before, it really was probably a business that was critical to the community, but really wasn't that. So it was not a thriving business, but it was more an opportunity for me when we played stickball up the block. If we lost the Spalding, I would get the Spalding from my grandmother's store. So therefore, I was a source for getting things out of my grandmother's store. And then my dad started it, kind of upstairs originally in the living room. He started an insurance brokerage business. And I guess when he was 17, he had gotten some kind of disease that actually blinded him. And for most of his life, actually, he had significant eyesight problems. So eventually he did, probably with my grandparents' help, start that business. And so therefore he started that brokerage business in our house. And that I did see kind of grow from the inception. And as a kid, I worked in the business with him and helped some, not that much. I was not an early kind of like pitching in, doing a whole bunch of things. But I do think that it was interesting because it really did give me a sense as I would say joke. I understood the property casualty business because my father was a broker, but he did underwriting. So as I say, when the Paganos across the street wanted insurance, that's the guys who ran the numbers and got arrested every so often for making book. So they came in, they went with this insurance company. But the Veteroses up the block, where they came in, they tipped the car, didn't go anyplace, was really pristine. He put it with his top-rated company. So he was effectively underwriting, knowing which ones have exposure to loss here and which ones don't. So, how that works and how the insurance business works was, I had a ground floor opportunity to understand a business that's a strange business. Property casualty insurance is its own little industry with its nuance. So it was interesting.
And am I right in thinking your family, at least half of it, came from Italy, right? I think I had read somewhere that your father, who had this wonderful name, which I don't know if I'm pronouncing right, which was Baptiste Robotti, actually helped to build the Empire State Building when he came to America?
So my grandfather, who is Baptiste Robotti, we lived in Long Island City. There was a stone company down the block called Gillies & Sons, and Gillies & Sons had been in business for many years. And fortunately, his good fortune, the original chief draftsman was the son of the owner. And the son in a major building forgot there were 4 sides to the building, and he only bid it for 3 sides to the building. So when they lost an awful lot of money, he lost his job, and my grandfather got promoted. And the company did a lot of work with limestone, and it was a critical change in construction, right? So the Chrysler building was one of the 2 buildings that fought with 20 Exchange Place for the tallest building. It's the last brick building that was built. It's the tallest brick building in America, in the world. And then, of course, when you built the Empire State Building, you went to limestone. So you could put up steel girders, you could slap pieces of limestone on it. So there was an extremely efficient way to do that. And that was the company that my grandfather had worked for. So he was the chief draftsman. And so we have in our conference room, we have a couple of blueprints I have it from the 47th floor of the Rockefeller Center, because that after they did the Empire State Building, Depression came and Rockefeller Center was built, and that's all limestone. So he did work on that. He worked on St. John of the Divine. So he was fortunate, happened to be at the right place at the right time, and ended up with a phenomenal job during the Depression. And so therefore really did pretty well and accumulated some money. And so we owned some real estate like that was down the block from the neighborhood we grew up in. And so therefore that gave, the family, definitely a good sounding place to start from.
And so you went off to quite an old and distinguished Jesuit high school, I think, and then went to Bucknell University. And I remember hearing that you had graduated, you said, with a C as an accounting major, and that you didn't apply yourself. You weren't a good student. Is that right? You just were not hugely driven or ambitious as a youngster?
Well, I was driven and ambitious, but not for studies. And so therefore in high school, I did reasonably well. Each progressively. So in grammar school, I was the valedictorian of my class. But then in high school, I did okay. So I was the top third. But I was busy trying to play football and do other things, and occasionally did some studies. But that's what I did do. I spent my junior, senior year figuring where I was going to go to college, because I knew I was going to goof off. I knew I was going to get a C, and I figured the better the school I can get into, well, then the better the C from that university. So as it turned out, Bucknell, Lafayette, Lehigh, Colgate were the schools that I identified that I thought were in the tier that I could get to. And of course, that was also what I applied as a major, because my verbal score is 490. So I'm a kid from Queens. I can't speak. I can't write English. But I did get a 710 in math. So therefore, when I applied to Bucknell, they have a really good engineering school. I'm not going to apply there because it'd be harder to get in, but they have a business school that at the time nobody applied to. So it was mathematically oriented, and therefore I could hopefully skate in when I shouldn't have gotten into the school. And I got into Bucknell and I graduated with my C. So I got exactly what I thought would happen. I fulfilled my expectations to my disappointment probably in aggregate from that. So yes, that was, and of course I attribute in large part my success to the fact that I got that C, and the fact that, so when I got to Bucknell, the question was, what major do I have? There's a management major and there's an accounting major. So here I am with the football team. So I'm talking to players and say, okay, so which is the easier major, management or accounting? And they say, oh, the accounting professors are guts, become an accounting major. So that's how I selected accounting as my major. So I got in through, the business school, which is the easier part of Bucknell at the time. And then I became an accountant because the accounting program was easy. And so when I graduate with a C, well, I'm not going to get a job with the big 8 accounting firms. So there were not 4, but 8 of them. Still, that wasn't. And in New York, there were 25 large accounting firms, but none of them could I get a job with. So therefore, it ended up the job I did get was my father's childhood friend was a guy named Fred Puglisi, and he had a small accounting firm, Pusterino Puglisi. January in my last year, he gave me an internship, and I didn't make a fool of myself. So therefore, he thought, okay, maybe the guy just didn't apply himself and is smart enough. And so I started working for Pusterino Puglisi, and I fell into the right place that therefore opened up all these opportunities that formed my life.
Yeah, Anthony Pusterino turns out to have been an incredibly important figure in your life. And I was reading about him the other day, because he also was a professor to Mario Gabelli as well, who we'll discuss later, who became an important figure in your life. Right. And so, and actually, I think you and Mario ended up endowing the Anthony Pusterino Distinguished Professorship in Accounting. So tell us about him and what he did that kind of set you on this extraordinarily fortunate path by directing you to places like Tweedy Brown and Mario Gabelli's nascent firm.
So that's what happened. So now when I get the job for them, I also realized accounting is a profession that there's a right answer and a wrong answer. It's not like, what do you think, and give me your views. This is right and wrong. So I did start my MBA at Pace University 4 days after I graduated Bucknell. And I went 4 nights a week, and I went for 3 hours in the evening, and I spent the weekend studying. And of course, that ended up being like a great experience. So the combination of working for a smaller accounting firm, where I spent time in audit, spent time in tax, and moved around, it's a 25-person firm. So therefore, you're applying during the day, and that's night you're learning the concepts of accounting, and therefore the concepts become easy when you actually apply it. So accounting is a boring subject for many people, but of course it wasn't. It was, I could see it live and in action in the information it gave you about companies. And as that was it, the business of Pastorino had two pieces. One, I would do daycare center audits in the worst neighborhoods in New York. And so this is 1975, right? New York City is about ready to go bankrupt. There's been urban flight out of New York businesses and individuals. So therefore, it was a tough time, and I would go to very tough neighborhoods. So that was the one part of the practice. But the other part of the practice was there were all these investment advisors that were the clients of Pastorino Police. And one of them was Tweedy Brown. And so that's what it was. For 4 years that I was there, I worked on the audit of Tweedy for 2, 3, 4 months of the year. And so that was a formative experience at a formative time, right? Because as I mentioned, the timing of that could not have been more opportune for me. It's 1975. So you have 73, 74, the market correction, market down 50%. One decision stocks, right? Didn't matter what price you paid for them. You bought them, you owned them because you'd absolutely always make money at them. Potentially arrived to where we are today in certain ways, had come in corrected. And therefore it was, as I said, the starting gun for value investing. So Tweedy became an overnight success after being in business for decades, because what they did and how they did it was something that was at the right place at the right time. They owned the right kind of company. So them in Mike Price Mutual Shares, Gabelli, Ruane, even Buffett became well known around that time because value investing stocks really substantially outperformed. And so therefore I happened to walk in, and then at Tweedy, right, who was there? Well, when Graham Newman closed up shop, next door neighbor was Tweedy Brown. And so Tom Knapp walked next door, and then Walter Schloss walked next door, and they were in the office when I was there. Ed Anderson was recruited from Charlie Munger to come in to run Tweedy because Chris was too young to run it at the time. So John Spears had just started working there. So, all these people were and they sat around a trading desk and they'd sit in offices someplace. And I knew what Tweedy owned, what they bought, why they owned it. And then one of the retired partners was a guy named Joe Riley, who was originally Tweedy, Brown, and Riley. Riley was in every day. That's where the auditor sat with him. And at 6:30, we talk about investing. And so I saw what Tweedy did. I saw what they owned. Joe worked with me, went through the investment process. So, it was a great introduction to investing. And as a result, I never was a finance major. I didn't know the market was efficient. So I didn't understand that nuance. Instead, I thought it was pretty inefficient because you could pick stocks that were substantially undervalued.
And Tweedy Brown, for our listeners who don't have a sense of it, was such an extraordinary firm. I talked to John Spears about it on the podcast for people who want to go back and listen to that episode. But literally, this is the place where Buffett bought the bulk of his shares in Berkshire Hathaway. He wrote about the company in his famous essay from 1984, Super Investors of Graham and Doddsville. So these guys were real stars. But this was at a time when no one really wanted to do value investing, right? I mean, they were mainly looking at these tiny stocks on the pink sheets and the like, right? Can you give us a sense of the opportunity that existed where you started to see, if you actually look at small companies and particularly undervalued companies that are sort of off people's radar, there's a tremendous opportunity there? Because it seems like in a way they established a kind of template in certain ways for your career of looking at very cheap, undervalued stuff that was off everybody else's radar.
In the first John Train book, the chapter on Tweedy is called The Pawnbrokers, because Tweedy's specialty was making markets in all of these pink sheet stocks. And pink sheet stocks at the time, there were a lot of them, because what those were securities that were companies that were created before 33 and 34. So before you had 33 and 34, the registration that came from that, you had companies that had gone public in a way, but therefore weren't subject to the SEC reporting requirements. And so there was a significant number of these companies, and that was originally Tweedy's differentiator, and they bought net working capital in a time when you could do that, because these companies were also a little bit, definitely more obscure and then out of favor. And then even the vagaries of the market, probably somewhat similar today, there, is not the universe that people were looking to invest in. They were looking at the Nifty 50. That's where capital flowed to. That would made sense. That's where you made money. You didn't make money. So they were obscure companies that were neglected. and therefore had valuations that were extremely discounted. So I'm a CPA, right? So therefore I can calculate net working capital, right? So this was not a sophisticated business, and it wasn't technology that I had to understand. This was looking at a balance sheet and doing an analysis and finding companies that were trading for far less than what the liquidation value of the business was. And Tweedy had grown successful. And therefore, eventually when I started my own firm, we did a lot of pink sheet stocks also because Tweedy couldn't put capital to work and it did it efficiently. They were doing a lot less in it. And so therefore it opened up the opportunity. And that was easy work to do, was to be able to buy cheap stocks. And that's what we initially did.
There are a couple of things I'd just like to highlight initially as we keep going through this story, right? So as we start to draw lessons that are relevant for our listeners from your early career. The first of them is you had real skills. I mean, the fact that you had this hard accounting background gave you some kind of competitive advantage. The fact that you were looking in an area where other people weren't looking for the most part was a tremendous advantage. The other thing I think that was key is that sort of older generation that you were seeing of Joe Riley, and I think you mentioned Walter Schloss, who kind of camped out in that office, just in a corner. And you knew Irving Kahn as well, who I wrote about in The Great Minds of Investing, who famously lived to 109 and was another of these great old investors. They had kind of internalized these very timeless principles from Ben Graham that you were indoctrinated with early on. And so I wanted to get a sense from you, when you think of the most important tenets, the principles that you came out of that period of 4 years at Tweedy Brown, what would they be?
I guess the most important things are the foundational emotional things. So markets are inefficient and there is opportunity, and that inefficiency provides huge opportunities. And so I've never thought the market's efficient. I think, and of course today I think the market is like less efficient, especially in a timeline. If you look at a 3 to 5 year basis, there's a whole bunch of mistakes that investors and markets are making today and providing great opportunity. So the other experience that I had was the very first thing first security I ever bought was in 1975. I did buy New York City housing authority bonds. So the city was going to go bankrupt. And so the housing bonds traded at 33 cents in a dollar. And so I thought, maybe it doesn't go back. Then maybe if I buy a dollar for 33 cents, again, that's a value. Easy to do the calculation to see. I can see how there's value in that. And as it turned out, of course, the city didn't go bankrupt and my housing authority bond paid off at par. And I collected significant interest in the short term. So the very first security I happened to buy was a troubled, financially distressed situation. And the other thing is I have the rule I don't know sell stocks. I tend to own things forever. And so therefore, and eventually things to work out and potentially huge opportunities come from things that have been abandoned, exhausted, and depressed because the valuation only goes down when you disappoint. And so therefore the spread between what the value might be and what the price is in the marketplace gets wider and wider, and the opportunity therefore gets greater and greater.
There was a very nice quote that I read in one of your shareholder letters that I thought really summed up nicely the core of what you do, where you said, the price you pay is the most critical element in all investing. No matter what is happening in the world, no matter how crazy it is, the price you pay is the one lever you can always control. Can you talk a little bit more about that? Because it seems like such a fundamental tenet that a lot of people who've got carried away with these kind of the nifty 50 stocks of our own era seem to be forgetting.
Well, today's world valuation is particularly important, right? And it's something that people have kind of forgotten, and I think it is a critical element. Of course, it frequently is not the real determinants of the value we pay initially, because we frequently find that in the interim, once we buy it, as with many value investors, we buy it too soon, and the value becomes troubled. But as I said, I don't sell, and so therefore, as it becomes more troubled, either the situation and/or the price therefore discounts more, then I have a recurring pattern of I buy more. And so I do say that the stocks that we made the most amount of money in over time are ones that initially after a purchase disappointed and traded down. So the idea that, somebody has a rule of thumb that, down 20%, I'm out of the stock, I move on. It's kind of that's non-existent in our conversations. And now, of course, the corollary to that is, Buffett's, of course, famous for saying the first rule of investing is don't lose money. And the second rule of investing is don't forget the first rule. Well, we forget that rule all the time. So we will buy things that are troubled and financially stressed and have risks to them, including the solvency of the business. And we've done that. And we've been too soon, and they have gone bankrupt. But the opportunity in that business, in that industry, persists in a different form. And therefore, we make sure we follow the buyer. So in manufactured housing, when that happened in the early 2000s, when Fleetwood went bankrupt and Palm Harbor went bankrupt, and both of those successively were bought by Cavco, or we bought Cavco. So we continued to do that. Or when Tidewater went bankrupt, I bought Tidewater out of the bankruptcy again and loaded up on it. So the opportunity continues to persist, even if the company doesn't, and the opportunities become substantially greater when that stress is happening and the economic response to stressful situations in poor economics in industries.
Before we move on from the Tweedy Brown portion of your career, can you just tell us if there were any particularly memorable moments, for example, in 1987, for example, where you saw the reaction of these old timers, the Joe Riley types or the Irving Kahns, and you saw how they dealt with extreme volatility?
Well, so 1987 was a particularly interesting time, right? So, it wasn't long after I had started the business. I didn't really have much of a business yet. Market corrects, as much as it did. I thought about my grandmother's farm upstate New York. It was still in the family. I said, well, maybe I'll go farm my grandparents' farm. But what happened was one of the big investments we had was in a company called Philcorp. And Philcorp was the recapitalization of the old Baldwin United, and had been in bankruptcy, had come out of bankruptcy. And Leucadia National, Joe Steinberg and Ian Cumming had identified it and acquired control of the company. And so therefore, it was a focal point of what we were doing in 1987. So, stock traded at $5 a share. And one of the things they had was they had a surplus note in an insurance company in New York called Empire Insurance. Now, my dad wrote insurance business for Empire. And so I had met the CEO of the company at, a broker's dinner one night. And so therefore called him up and met with the CFO to say, gee, you're in the process of demutualizing. And that's what it was. The demutualization process was a year and a half underway. And what was going to happen was the equity was going to be distributed in return for the surplus note. So they were going to own 75% of the company. The company the year before had earned $18 million. So they're going to earn $13 million. There's 13 million shares outstanding. So there's $1 of earnings that will pop up out of nowhere. It's a $5 stock. What Leucadia, Steinberg and company had done through the year that he controlled it, where they were selling off assets and raising cash, eliminating all the debt, accumulating cash. In the meantime, they said, oh, if we sold it at a loss, they took it through the income statement. So the earnings looked terrible. In the meantime, they said, if it was a gain, well, we had intended to sell it. And under quasi-reorganization accounting, we're going to book that directly into stockholders' equity. So we're not going to take that through the income statement. So they're putting all these losses through the income statement. They're not reporting the gains, accumulating cash, and this insurance company's got to pop out of nowhere. So I'm excited. This $5 stock's worth 2, 3, 4 times that. And it has a huge NOL, and they use it as a mechanism. Then the crash comes. Well, of course, everything goes down when the stock market crashes. So it goes from 5 to 3. And so then what happened was Leucadia in 1987, 1988 created a huge amount of value. Philcorp, Braycorp, the demutualization of Empire Insurance, they eventually then took it private at a fraction of what that business was worth. So those things gravitated my interest, and the value was so clear and compelling at the time that it was like, this is a great opportunity. And so therefore, and confirmation that Leucadia knew that, because they proposed all these transactions where they would try to buy the whole company, buy the whole thing and take advantage of the fact that the market wasn't efficient and they understood what the values were here and they were far away from what the intrinsic values were and were opportunistic. And so it's easy to be opportunistic and invest when somebody that's really smart, that really knows the situation much better than you do, is investing their own capital. And if I can, go alongside that, that's a great opportunity. So that was a opportunity based on a fact pattern and a situation that was critical and informative for us.
It seems like one of the major evolutions that you went through in terms of your investing style was that you started to understand the power of aligning yourself with these owner operators like Joe Steinberg at Leucadia, or more recently Christian CM at Subsea 7, or the Gottwald family at Ethel Corporation, or the Chow family at Westlake, where you could see that there were really smart capital allocators so you weren't just buying cheap stocks. Something shifted in you. Can you talk about that? Because it seems like such an important part of your own evolution as an investor.
Well, so that's what it is. So we bought cheap stocks originally, and cheap stocks frequently, sometimes they deserve to be cheap because they're really not good businesses. But certain times they are controlled by someone who is a great capital allocator, who also sees the same opportunity and is buying in and is using it as a vehicle. And so therefore, how they think about that and what they do and how that really changes the opportunity set. And then, of course, that's frequently in businesses that are cyclically depressed, that are going through difficult times. So therefore, someone who has a longer term vision. So that's what it is over time, that's what we've done, is we've identified these opportunities that are from aligning with the right people who can be opportunistic, that have the capability and have the ability to do that from an intellectual point of view, to capture those opportunities to go along with that. So that has been critical. But what worked? Who to align with, who to invest with, and what situations, because sometimes it's not just the people and it's not just aligning. It is a business that is substantially discounted and opportune. And so, one or two of the building related companies were not based on, it was a better management. It was a better business that was in a consolidating industry that was extremely well positioned. So there's a combination of factors. I do say investing is a mosaic. There's a lot of things you look for, and you don't necessarily have to have all of those pieces for it to be a compelling investment opportunity.
When you're trying to assess the management and you're looking at the quality of these people, whether it's a Christian CM or a Bruce Gottwald or a Joe Steinberg or the Chow family or whoever, like what are you looking for that's a good indication that this is someone you want to align with? And what are you looking for also inversely that makes you think, God, I'm staying away from these people?
No, I don't stay away from this. So in 1987, 1988, with Leucadia being opportunistic, right, we were shareholders in Philcor. Actually, I remember Alan Kahn connecting me with Chuck Royce and going to visit him and Whitney Tilson and saying you should buy Philcor. And a year later, Whitney Tilson calling me up and said, why'd you tell me to buy Philcor? Why didn't you tell me to buy Leucadia? That's where the value is being transferred to. This stock's cheap. And in Leucadia, I just saw what they were doing, and I saw the opportune situations and the discounts and what they were. So I lived through Leucadia. I didn't know Leucadia and have kind of the history of it, as opposed to Christian C. When I came across him, he had already had a record of being successful in acquiring assets in a depressed business at an opportune time, capitalizing that, converting the company, merging it into someone. So he had already, other people as life has gone on, the Gottwalds are people who clearly have a long-term, decade-long record before I came across them to say these are money makers who think about capital allocation because they own a lot of stock themselves and understand the businesses and not only control it, but understand how do you allocate capital, therefore maximize the opportunity for investing. So it's kind of different in those situations because in 1987, 1988 with Leucadia, I did sue them 3 times. So initially when I started in business, and you're buying small companies that potentially have a huge disparity between price and value, controlled by a really shrewd guy. Well, one of the things that really shrewd people do in situations like that is take advantage of that market disparity. And therefore, they start to do things that they can. And so therefore, part of that outcome is, gee, as the little minority shareholder, I used to be like, gee, that's not fair and equitable. And so therefore, I would I was the named plaintiff in 25 class action lawsuits. And 3 of them were in 87, 88 against Leucadia. So there is risk in it. And, even today, having a chat with Alan Kahn, and we were talking about CM Industries and Christian CM and his concern about what's going to happen with CM Industries. And I said, I don't know what's going to happen there, and you're at risk that the asset value is different than clearly the trading price of the stock. And, there may be a movement of value that doesn't get equally dispersed, as I say, in these situations. When there's a guy who controls the company, you deal the deck. One for you, one for me. One for you, two for me. One for you, three for me. One for you, four for me. So that's a risk. But if you buy it at a big enough discount, if you end up getting half of what it's worth, then that's probably a really good rate of return. And so, that's part of the equation that you have to do that calculation. And what is this thing worth and what is the opportunity? And therefore, if I don't get full value, do I still make a great annualized rate of return in that investment?
I wanted to go back in time a little to after you graduated from Pace Business School in, I think, 1978. And you got a job also through your professor, Pastorino, working with Mario Gabelli. And you were there from 1980 to 1983 at a time where Mario wasn't well known at all. And I was wondering, you spent 3 years there, and you've said before that you would listen every day, even though you were the CFO, you would listen to him talking about his favorite investment idea every day. Can you talk about those experiences and what you learned from Mario, who's very, very sharp? And I've interviewed Mario a bunch of times, and I've told my friends who worked with him that he was not an easy man to work with, but clearly very sharp and full of bombast and a great researcher. And what was that experience like for you?
Well, of course, we knew who he was, and actually, Alan Abelson had already discovered Mario, and so therefore, his business didn't in any way match what his personality, and reputation were. And of course, when I started working for him in 1980, he started the firm in 77, and so when I started, there were 12 people who worked there. He managed $7 million. The main part of the business was he was originally an institutional analyst on the sell side before Mayday rates happened, and therefore that was a lucrative business. And that business from 72 to 77 disappeared, and then it ended up. That's what happened. William Witter, where he was got bought by Drexel Burnham. He spent 3 weeks at Drexel Burnham and decided this is not what he wanted to do, so he went out and started his own firm. So his main business at the time that I was there was doing institutional brokerage business, and so that was the economic driver of the business. And so it was $7 million is what he managed when I first started to work for him. And so that was only beginning. Now, of course, the amount of capital he had, intelligence he had, the fact that one of the industries that he was very active in was the cable industry and entertainment, and that business was in the process of exploding. So, it was a combination of factors, and he is very quotable, very, has a persona that Alan Abelson then loved and therefore broadcast that. So those things all kind of helped Mario leapfrog. And so when I left, that's what it was. He only managed in 83, $77 million. So it was still a very modest amount of money. But so every day he had his morning meeting because it was his brokerage business to talk to the 4 salespeople to go out to sell the idea he had. And he'd go through his investment thesis. That's what I say. I had an executive MBA program taught to me almost one-on-one by Mario Gabelli for 3 years, where he went through his favorite investment thesis and what it was and what the company was. And he paid me to attend the class. I didn't pay him to attend the class. So it was a phenomenal opportunity. And it was a 12-person firm. And so I was the chief financial officer, chief operating officer. And that was when I first started to work for him in 1980. We used to clear through Bache & Company. And that's 1980s, the silver, with the Hunt family, the silver implosion. And Bache is going to go out of business. And we're a broker dealer. So therefore our money is not protected. So Gabelli's about in the process of potentially losing all its capital. And so therefore we had to scurry around and go over and, move the business and get that out of the way. So things happened that were really interesting. And I worked with Mario intensively on a one-on-one basis that entire time. So, he's a great businessman in addition to being a great investor. So therefore that experience was, again, couldn't have asked for a better opportunity.
What stuck with you in terms of how you analyze investments, how you talk about investments, but also how you run your own business? Because he's shrewd. I mean, it struck me when I think it was the last time I interviewed him, he said to me, no, I don't read any books. I never read a book. Why would I waste time reading a book? I read all these journals every day. I'm just an information junkie, an information hound. And so he's got a very distinctive personality, this sort of voracious appetite for information, for getting an edge. Was there stuff that just by watching him operate, you think has actually stuck with you, or are you very different?
Personalities are very different, because he is, he's a taskmaster. He's hard to work for. He's a demanding person, has high expectations, and doesn't let you know sometimes if you don't meet those expectations. So he's a different person than I am. I think in terms of interest and curiosity, I hate to say it on air, but I don't read books either. I hate that at the end of interviews, but people always say to you, what's your favorite book? What have you read? And I'm like, I feel like I'm an idiot now because I don't read any books. And that's what it is. I read annual reports. I read through, letters. I read journals. I read all these other things. So I have an interest in stuff, but I don't read books. And so there's a similarity, of course, we really do have between us in that way. So interest in businesses and how they work and how they operate. And I think that's been a critical thing, is understanding the latent earnings of businesses that are not earning something today. So, that's a phrase that comes up a lot. Of course, when you do value investing and you do asset-based companies, you talk about value traps. And so, I think that value traps are kind of like, in what time frame are you talking about? Because recently I hosted a dinner about a month ago. So I had about 10 of us there, and I invited a bunch of people who are still in value investing, active management, managing much less money than they used to, including people who don't do it anymore because they converted to a family office because they've given up and been given back the money and don't want to do that anymore. And the nature of my dinner was, I called it the restoration of the fallen, right? Using the line from Horace that Graham has at the beginning of security analysis. And that's what I think. I think the next decade is going to belong to stock pickers. And I don't care if that's technology companies, growth companies, industrials, financials, all of those have reasons to pick stocks and not the index. And the indexes will not outperform selecting stocks, and the ability to identify, do research, select companies that are well positioned and have valuations that are attractive. That is something that can be done today. And there are many fewer people doing that. That is not a productive effort out there today. And therefore, that means the competitive landscape is extremely limited. And that's where the differentiation is going to be. It's not going to be owning an index. It's going to be owning stocks. And so that's what I'm saying. It's the restoration of the fallen. Stock pickers, active managers in the next decade, I think have a bright future. And I think I'll be shocked if they don't outperform indices.
Let's unpack this in more detail, because it's such an important idea, this idea that we're going to see the revenge of the stock picker. I saw you recently, you said we're entering a new golden age for value investing, stock picking, and active management. So as we're trying to understand why that could be, can you explain this totally anomalous, weird period of distortion that we went through after 2008 that in some way has set people up to believe something, to believe certain principles that may not turn out to be permanently true?
2 years ago in my letter, I talked about financial brigadoon. And so that's, I think, the world in which we live today. And so brigadoon, as I'm sure you know, it's the Lerner and Lowe play from the 40s. And it's about two gentlemen on a trip to Scotland, wandering across the moors and coming across a little town, Brigadoon. It's an idyllic little town. Everything about it is just lovely. And so they leave and they come back the next day, only to find the town's not there anymore. And they ask someone, what happened? Where's Brigadoon? And the guy says, Brigadoon only shows up one day a year, every 100 years. It's gone. And that's what we have today. We have post the financial crisis, an extremely anomalistic period of time, an extended, extremely anomalous period of time. And the fact that it exists for as long as it did convinces people it was the new norm. And so therefore the distortions of people's thought process and capital is making the opportunities. And that's when people, today they say, well, gee, these opportunities, and they'll say, but they perform poorly. Yes, the poor performance is what sets the stage for the opportunity. The valuation and the pricing is giving you these opportunities because nobody believes that's the case. So there's a line from Bernard Baruch, and that is, data and information is no substitute for thinking. And so that's a particularly critical thing today, because I think the underlying economic environment from a world of very low inflation for an extended amount of time, depressed interest rates, low, no negative interest rates, people got to believe that that was the norm. And people, it's not, and anybody who graduated and lived in that decade-long period, and that's what it is. A decade-long is not like 2 or 3 years. Then you would say, oh, no, you haven't lived long enough. You don't know. You've lived a long time. That's the way the world works. And then even people in business, I do think there's been a gravitation that, well, maybe I am wrong and the world has evolved. So I really think that it's not only people with 10, 15 years experiences that have only lived through one world think that that's the norm. Everybody else has come to believe that. And that's what everybody believes is we're going to go back to that environment again. And therefore that capital stays where it is because we're going to get back to that. And I'm saying, no, that was an anomalistic period of time. It's not going to return. And therefore you have to be prepared and invested on who are the economic beneficiaries in the next decade. And they're going to be very different than who were the beneficiaries of an anomalistic economic environment.
You had a very interesting chart that you showed in one of your letters to shareholders that was called Decade Winners, where you show how the world's biggest companies by market cap change from decade to decade. So in the 1970s, these were energy companies driven by very high oil prices. In the 1980s, there were Japanese companies that dominated the global economy. Then you show how in the 2000s, Chinese companies came to the fore. Then in the 2010s, companies that benefited from low interest rates and the recovery from the global financial crisis.
Yes.
When you think about it in terms of this kind of passing of the baton in a way, like these different periods, how does that help to inform your sense that it's really dangerous to have this kind of recency bias where you're like, oh, well, whatever happened in the last decade is bound to continue because that's what I've seen?
Of course, it is recency bias, but it's easy to believe it's not recency bias. When it's been 10 years, you think, oh, no. If it was 1 year, that would be recency bias. But I have conviction it's not recency bias because it's happened for 10 years. So I think it's Jim. I'll attribute it to Jim Grant. There's a line that he says that in science and in engineering, knowledge is cumulative, and in finance, it's cyclical. And given extended cyclical periods, the idea that people think, they forget past performance is not a predictor of future results. And so therefore, what has worked isn't necessarily what's going to work. And there's all the more reason why there are rotations, there are cycles. And that's the phrase I have now. It's, I'm stealing the phrase from Clinton when he beat Bush for president. It's the economy, stupid. What's the economic environment? Which companies are going to benefit from the economic environment and therefore do extremely well economically? Those are the stocks that are going to perform well. And so to think about what companies, what industries are well positioned today, and for a combination of well-positioned, excellent growth and have valuations that also are heavily discounted because they haven't performed. And the conviction is they won't perform. Or I know that business, and that business is a cyclical business. Businesses change. That's what I talk about too. I talk about not the revenge of the old economy. I talk about the metamorphosis of the old economy. For industries that have done poorly for a long time are capital deprived, have consolidated, have restructured, and maybe the underlying economic environment is different where they've gone from being disadvantaged to potentially very advantaged today. And I think that there are many examples of that pattern of both the poor performance, consolidation, restructuring, and yet the underlying economic environment totally changing now, and therefore being extremely well positioned.
So you're looking at quite unfashionable old economy industries like chemicals and building products and lumber and energy services and the like.
Yep.
Why? What are you seeing there? And maybe you could give us a couple of examples. We're not that specific about stocks because I prefer these interviews to be fairly timeless. But if you could explain how these North American companies like LSB Industries or Westlake illustrate this kind of theme that you're seeing, where these old economy industries that had been largely dismissed by everyone who was excited about Microsoft and Apple and Amazon and Alphabet and the like are suddenly actually extremely attractive and maybe where the action is.
So again, here we are, bottom up stock pickers, and we're value investors. That's what we've always been. And the fact of the matter is, in the last 2 to 3, 4 years, I realized that actually I'm not that. So I'm in many cases a macro top-down investor, and I'm not a value investor. I'm really looking for businesses because of cyclical changes and structural changes have a significant amount of growth in front of them. So I'm really looking for businesses that have significant growth opportunities and yet valuations that are depressed. And why did that happen? And how did that happen? The economics 101 really does work. Capital does get pulled out of things, and therefore things are different. So the two major themes that we think are structural changes that we think are decade, 2 decade long kind of opportunities that will dictate who the winners are, I don't care who the losers are, so that I'm not going to short anything, so I'm not going to go through that part, but who the winners are. And so those two things are, one of them is anybody who uses the phrase deglobalization really just doesn't understand what's happening. And what's happening is, of course, it's the evolution of globalization. And therefore, things change. Different countries, companies, industries become advantaged, and that moves over time. And so therefore, and of course, we kind of know that if you think back long enough in history, right? Post-World War II, there was a period of time where Japan had its recovery and therefore had a significant positive period of time. And then what happened was it got to a cost level where the opportunity migrated to South Korea. And South Korea then had a significant period of time where it grew and had all these advantages. And then over time, that moved to China because China had all these advantages, including the scale of the population of the country. And so therefore that did really well. And what's been happening in China so Isaac Schwartz is a young colleague of mine who, when he graduated Wharton back in 2005, took a trip to Asia and said, Bob, we need to invest in Asia. I said, Isaac, I'm a kid from Queens. I don't speak English. I'm not going to learn a foreign language. How do I invest overseas? But he took me to Thailand in January of 2007, which is almost 10 years after the Asia financial crisis, which was the Thai baht devaluation was a critical element in that. And these stocks were extremely cheap, strong balance sheets, generating free cash flow, paying dividends, 7% dividends. And so therefore, I didn't have to speak Thai to understand that these businesses are substantially discounted in opportunity. So he got me to invest and think about the world as it is. And so with him, I've traveled throughout Asia. We visited 500 public companies over, the number of years he lived in Asia. And in that process, so I remember talking to a Korean company 15 years ago that no longer made garments in South Korea, where they started to do it when South Korea had a lower wage rate than North Korea because it was competitively advantaged. Over time, of course, it wasn't. So they said, well, let's go make it in China. And they weren't making things in China anymore. They had already gone to Bangladesh and Vietnam. So businesses have been gravitating out of China at some point for a long time. That process, I think, is going to accelerate. So therefore, I think it's the evolution of globalization. And the evolution of globalization is, it moves south and it moves west. So the next places it's going to is Southeast Asia with 650 million people and India with 1.4 billion people. So there's 2 billion people that are in the process of replicating some of what China did 40 years ago. And so that globalization process and the evolution means huge amount of infrastructure build out, huge amount of changes, huge amount of energy consumption. Because as you start that economic ladder, Japan, Korea, China, the per capita consumption of energy significantly increases. So you're going to see 2 billion people in the world start to raise their income level. So I think that's a critical factor. The other part of globalization about evolution is people say reshoring, which again is a misnomer. Not reshoring. It is North America is competitively advantaged in energy intensive business. Right? So energy, fossil fuels is something I've invested in 50 years. I think I have a really good understanding as to how those businesses work. Not that I know where the commodity price is going to be in 6 months. I have no idea where the commodity price will be in 6 months, but how those businesses work. But North America, because it has an abundance of natural gas that you can't export, has an energy cost that's disconnected from the rest of the world. And that is a persistent long-term advantage. And if you're doing something energy intensive, doing it in North America is a competitively advantaged place. So when I got out of college 50 years ago, we were competitively disadvantaged. Today, we're competitively advantaged in a large portion of the world's economy. And so therefore it's European businesses more than Asian businesses, but also Asian businesses that are coming to North America to take advantage of that long dated opportunity for excess profits and returns because of the low cost environment for energy, which will be persistent. So that's, again, a critical thing that I, think. And therefore, if you are an industrial business in North America, frequently there's three of them left. And there's an oligopoly that has the lowest cost and therefore is competitively advantaged against the rest of the world because labor is not a big component. It's the inputs, and the inputs in many cases, to the extent that you make a chemical and you use the raw materials, natural gas, and your energy is, supplied by either natural gas or a lower cost electricity, you're competitively advantaged. So you're going to make ammonia, fertilizers, chemicals in North America. You're going to make steel in North America because you're in the end market that demands it. You've got the iron ore that's domestic. You got the met coal that's domestic. You got low cost energy, and you have an industry that produces steel for substantially less CO2 per ton than the rest of the world does. So environmentally, we're competitively advantaged also. So these things are very different. That's why I say the metamorphosis of the old economy, because these are fundamentally, structurally different businesses than they've ever been. And in a period of time where activity in North America, given things like the Inflation Reduction Act and all of those other advantages, as we build out renewables, will mean the demand is growing exponentially, and therefore you're extremely well positioned for high growth. And yet valuations are extremely modest because, I know that business. It's a cyclical business. It changed. It isn't what it used to be. It's a butterfly today. It's not a caterpillar.
How do you get started with stock investing? I've put together a course to teach you everything I wish I knew when I first started investing in stocks. Let's start at the beginning and ask, what is a stock? Let's zoom on into what it's actually like to buy a stock. A few options are Charles Schwab, TD Ameritrade, Ally, E-Trade. Fortunately, you won't have to necessarily calculate all of these taxes yourself. I'll outline a few main ones to be aware of throughout your lifetime investing journey. As Warren Buffett says, your best investment is yourself. There's nothing that compares to it. By the end, you'll be savvier about stock investing and personal finance than the vast majority of people. Even if you're not a total beginner, I'm confident you'll get a lot out of the principles and strategies I outline, which we'll build on throughout. A link to the course is available in the description below. See you there.
So in a way, as you've mentioned before, it's analogous to when Buffett looked at something like the railroad industry and said, actually, this thing that was always a terrible industry is no longer a terrible industry.
Yeah, that's right. That's what I always do joke, because in 1975, I got out of college. That's what I say is, when I got out of college, there was a great business called the Wall Street Journal, because there was no across the street from the Wall Street Journal. And I interviewed with a railroad company and said, this is a horrible business, capital intensive, costs are too high. The thing just loses money like crazy. Why would you want to be in it? The fact of the matter is, railroads are inherently a monopoly business. To the extent that you have a rail line that goes from this place to that place, you are the low cost transporter of anything and everything. And no one's going to build a new one of those. So therefore, there's a barrier to entry, and therefore you have that advantage. So structurally, it was a business that has those positive attributes. And of course, today, the Wall Street Journal is a vanity thing for people who can afford to lose a lot of money and can't make any money anymore. So things change, and people don't have the perspective of, there are cycles, there are things that happen, and what is true today is not necessarily true tomorrow.
I remember Bill Miller many years ago. I think when I was following him around back in about 2000 to write a profile, or 2001 to write a profile of him for Fortune, said to me, the biggest problem in markets is that things change. And it seems to me such an interesting thing that in the last few years, even among many value investors, it became almost an orthodoxy that you should own higher quality companies, and that even the value investors became kind of almost like nifty 50 kind of investors, right? And I was wondering how you dealt with that issue, because that did become almost the dominant way to win within your community.
So there are two types of value investors in my mind, right? There's the value investor like me who owns hard asset kind of businesses. And, so maybe that's also Curtis Jensen, who joined us a number of years ago, Third Avenue, Marty Whitman's firm, right? Or, there's a lot of examples of firms that, were that. And of course, they had the misfortune of being very successful in raising a lot of money. And so therefore, back in '06, '07, '08, '09, they had billions and billions of dollars. And so therefore, those businesses then have imploded substantially. There's the other value investor who was smart enough, who did buy Apple, Microsoft, you name the company when it was a cheap stock and it was a value stock. And therefore they had the good fortune not to sell that thing over time too, right? Because they would have truncated their opportunity for profits. And so those have grown to be very successful investments that they're kind of stuck in today. So the value guys who performed well are the guys who held on to those stocks and probably have bought in a little bit more to the idea like, gee, there is maybe better businesses are worthwhile to pay a higher price for, And again, you hear Warren Buffett say that, and therefore you apply that to every situation. Oh, it's a better business to pay a higher price. When do you start to confuse yourself as to what's a better business? And when do businesses change over time? And it was a better business, but does it change? And does it continue to have that? So value investors have gone two different ways. They've either imploded because they bought hard assets and therefore those things have been out of favor. And we're fortunate because we didn't manage a lot of money. And the money that we have is from people who are really long-term and have been with us for a long time that we've made returns for. And so therefore because that's a critical piece. If my capital wasn't aligned with me, then I couldn't do what I have done because they wouldn't have stayed with me through the lean years. And there were definitely a bunch of lean years to the point where, we've done really well the last number of years. And I think we're extremely well positioned today. So those are the two pieces of value investors and how they've kind of changed over time. And the ones that have adapted have money, but I think also have valuation issues that they have in their portfolios and businesses that have done well and could do well. And again, that's why I say it's a stock picker's decade, because, even the Nifty, the Magnificent Seven, I heard the Bloomberg the other day say the Magnificent Six. So they've already kind of like, they identified one of, and that's what'll happen. It's the same thing that happened with the Nifty 50. Some of these businesses are phenomenal businesses. And the reasons the stocks have gone up is because the economics have been strong. And so it's not what it was in the dot-com era where the valuations on things made no sense and there were businesses that weren't worth anything. These are real businesses that have had, significant economic returns, and then still some would, but some of them won't do well. And I don't know which ones those are. And if you pick the right ones, you'll do okay. And if you pick the wrong ones, you have clearly valuation risk in those securities.
When you look at investors who bought into the idea of just owning, Microsoft and Apple and Amazon and Alphabet and Meta and Visa and J&J and JP Morgan, these kind of super successful US companies that benefited from that period of low interest rates and the recovery from the financial crisis. Is there something in particular that they're forgetting that not in terms of wagging the finger, but if, as someone who's been in this business for 50 years, if you could just give people some sort of sage perspective, because I think often we look back on periods where it seems obvious in retrospect and things were sort of inevitable. And I'm always like, why didn't I listen to Howard Marks at the time? Or why didn't I listen to Buffett at the time? Or whatever. Can you put into perspective what it is that people ought to be thinking about as they're framing companies like that have been so successful?
But I think a critical thing is valuation. So I regularly quote in the 2011 letter, Buffett made a point of talking about fixed income, and he referred to Shelby Colin Davis's famous line that bonds were a return-free risk. That was in 2011. So that was a long time ago, and for that entire time, that didn't come home to roost. But of course, what's my risk-free rate of return? And so therefore, I saw the risk-free rate of return. I actually think go back 2-3 years ago, it's kind of like, how do you figure a risk-free rate of return? Because if he's figured the 10-year treasury, but the 10-year treasury was like lower than what the inflation rate was. So the real return on the 10-year treasury was negative. So if your risk-free rate of return is negative, and then I got to put the premium on top of that, well, what's the premium on top of that? And where do I start? So it seemed to me that the foundation was in the wrong place, because if nothing else, there was no margin of safety in assuming that was your risk-free rate of return. And yet in real estate, capitalization rates were all predicated on those low returns. And so therefore, so the real risks in my mind, because I think capital today is substantially misallocated, right? It's been allocated based on an environment of free money. and the presumption that that's the norm. And the fact, and of course, we talk about public markets, but the other market we haven't specifically referenced is the private market. So private markets, I think there's a huge amount of risk and more capital goes there, and it's allocated to private markets and private markets valuations move slowly. And what's the right rate of return? And the right rate of return is going to be determined by the dog and not the tail, right? The tail is the Fed and the dog is inflation. The dog determines interest rates. The tail, the Fed, does not determine interest rates. People think that that's the case. If I hear one more time on the radio, 4 times on TV, like, what's the Fed going to do next? And they're going to raise rates. I'm like, would you get a life and figure something that is relevant? Because the Fed is going to be forced to respond to what inflation is. And the Fed can't control inflation. And so that's the critical element. And valuations, all real estate, in my mind, has risks of coming down in valuation because cap rates are going to change. Because where does inflation moderate out at will determine what the right interest rate is. And then we'll fix where capitalization rates are. And the private markets are things that, I recently saw a study Cambridge gave to us being one of the things I do is I chair the Pace University endowment. And they said, the multiples have come down. So they went from 10 to 11 to 12, and now they're down to 11. And I'm like, wait a second. They went from 12 to 11 and interest rates went from 1.5 to 4.5. Somehow that doesn't seem like the right adjustment. That number's like wrong. And so I think private markets, which are levered, and real estate, which is levered. The nature of those assets are you always leverage those assets because they're very leverageable. And if you start to change multiples because inflation is higher and the interest rate is different, your risk-free rate of return is different. And that just takes time because those markets don't reprice quickly. So I think the risk is not necessarily in the public market so much, even with the higher valuation stocks. There are these other markets that mark to a model and therefore, are less volatile. Of course, we all know the answer to that is, no. I invest in a business, right? That's in the public markets. And the stock price may be volatile, but the risk and the volatility in that business is no different than the one that's sold in the private market. So our risk largely, or they're not that dissimilar. And yet one goes like this in price and the other one like this in price. And in a period of time when interest rates have changed radically and therefore discount rates should be changing radically and one's not changing.
In its structural terms, it feels like something has really shifted that I'm sure you're seeing a lot when you're advising endowments and the like, right? That the people who are making asset allocations are thinking very differently than you are about the value of indexing and the importance of private markets and the like. What's happened to value investors given the rise of passive investment, the rise of algorithmic trading, the importance of short-term information and the like? Like, what's happened there and what opportunity has that created for people who actually do care about valuation?
The opportunity, I think, is huge, right? So and in the last 22 was interesting, 2022, right? Because it said, one thing that happened that year was both bonds and stocks were down more than 10%. And everybody says, oh, that never happens. And I'm like, whoa. When you have 1.5% 10-year treasury, and if 1.5 then goes to 3, what do you think happens to a bond? What do you think happens to a stock? How did you say that? Like, who would have thought that would happen? If you had thought about it, of course you would think that. And you should have thought about it because that's the margin of safety. There was no margin of safety. That pricing, that assumption set the pricing for both of those markets. And then if you change that basic premise, obviously they move. So 22 happened and bonds and stocks had terrible performance. Somehow people have forgotten that. They've relegated that to like, that was a mistake. And of course, the critical element that happened, there was inflation happened. And therefore, where did that come from and what caused it? And we're of the camp, again, so there's one of my colleagues worked with me many years, has this concept of grassroots macroeconomics. And so that's why I said we're a macroeconomic investor. We're not a bottom-up stock picker who think we're agnostic on the macros. Because when you understand a business and you understand the industry and you understand industrials that are a component of the business and the industry, you understand, I think, the drivers. And we see all these things that are really inflationary. And so the globalization and the movement of globalization, when you move to the rest of Southeast Asia and you move to India, it cannot be as efficient as where the Chinese economy is today. Yet costs in China are different than where they are today also. So therefore, it's not the same place with the same cost structure it had. So I would submit that China, of course, that's what's really happened, right? Post the finance. So again, I'll come back to this concept. I think the Fed is at the margin, has no ability to influence the really big things in life. And I don't think Volcker cured inflation. I think China cured inflation, right? Because what we did over 40, 50 years was industries, disappeared in the rest of the world and they all moved to China because China had all these cost advantages and can do these things and make all these things for much less than we could. And what that did was we bought stuff for the same thing we paid 20, 30 years early. So therefore inflation was sucked out, so it wasn't, as Ross Perot said, the giant sucking sound was in Mexico stealing things from North America in 1992. The giant sucking sound's been going on for 40, 50 years. And therefore it's moved to China because they can do everything cheaply. But the costs in China now have risen because now they become a net importer. So when it comes to making steel, suddenly they're at risk of being the high cost producer because they have to import iron ore, they have to increase met coal, they have to increase energy. So the critical variable costs, they're high on the cost curve. Labor is a small component of making steel. It's not a labor intensive business. Who cares? You got cheaper labor. And so therefore, and now when they started that process, they had all of those things internally. And they were advantaged. They had an end market that was, had the demand and they could supply everything internally. Now they've got to import all these things and then the high cost import. So that's a radically different place. So I think China is least done and probably feeds inflation in. And as you move to someplace else, it can't be as efficient given the, when when Apple thinks about, okay, we're going to set up a line in India, it's going to be higher cost than what it is in China. You can't replicate the efficiency that you have, the scale that you have. And so therefore I think, and then the other thing is energy. So we've been fossil fuel investors from day one. Energy transition is obviously something that's going to continue to accelerate. And energy transition is going to be something that is going to be inflationary because the build out of the infrastructure that you need, the call on materials that are already in tight supply, mean all those material inputs are going to cost more money. And so therefore you're going to have recurring commodity cost pressures as you build out. And that's what it is. When you build out renewables, you need steel, cement, and you need all these basic materials that are in tight supply today. And so therefore we think inflationary situations, and energy too is the same thing. Those are inflationary. And therefore inflation is going to be more persistent at a higher level. And when financial brigadoon happens, people give up, that's not going back to brigadoon, and interest rates adjust to the right rate where inflation levels out at. It's either going to be at higher or potentially reasonably higher than where we are today. And people will give up and say, it's not going back. And I can't invest based on the hope that we're going back to a 2.5% inflation rate. Because that's a hope that seems to me to be hard to get the genie back in the bottle. And therefore you're not going back to that rate. And therefore you have to reprice what you own based on that risk-free rate of return, the risk associated with that investment, especially if there's incremental inflation that's going to affect your business too.
I wanted to focus a little more on energy because it's obviously a hugely important area for you. And I was looking at, I think it was the April 30th, 2024 statement for Ravenswood Investment Company, which is a limited partnership that you've run with great success for decades. And if I was reading it right, you had something like 62% of the portfolio in energy holdings. And so it's a massive area for you. And you've also, as you mentioned, been investing in energy since the 70s. You're putting your money where your mouth is here when you look at this huge structural trend in energy. Can you explain why there's such a massive overweighting in energy in your portfolio, but also how companies like Tidewater or Technic FMC or Subsea or whatever other big positions you choose to mention, how they illustrate your way of positioning yourself to take advantage of what you see happening in the world of energy over the coming years?
It's individual stock selection. I'm not buying energy broadly, and it's valuation, right? So it's easy. It's simple. It's really not that complicated. So the valuation part is, in certain parts of the oil and gas industry, the service parts of the business, so the picks and shovels parts of it, right? There's a true north. The true north is, what's the replacement cost of that asset? And of course, it's predicated on the concept that, that asset will be one that will be in supply demand balance, or, in tight supply. And therefore that means the economics will be determined by what it costs to build that asset, because you're going to need more assets. And so where is that? And that shows you the earnings potential of the business, and that shows you the value of that business. And what's happened, of course, is the focus of what I do in energy, a lot of it really does tend to be offshore related in service picks and shovels. So that means in 2017, energy had a really good run, but it was all onshore, it was all shale. And I did nothing in those years, and I did not participate in it. So therefore, again, it's stock selection. And, in that case, I underperformed because I didn't own the right energy stocks. And of course, what's happened more recently is, oh, no. The onshore has its place and offshore has its place. And that place has finally come to what the underlying economics are and what the opportunity set is, and what the size and the scale opportunity of that business is. So it is the realization of something that I've invested in all along, and that the market couldn't care less about 4 years ago when I could go through the litany of really smart value investors who do cyclical energy kind of investment. So it is the kind of thing they would invest in. It's not like, oh, I don't invest in that thing. No, this is what I'm saying. No, I have no interest in that. And in the meantime, Tidewater, it's boats. That's what a year ago I was at a conference, and I said, okay, the stock pickup I'm going to have today is, I'm going to talk to you about a real estate company. And the real estate company is one in which the real estate's been converted, shut down, ripped down. There's no new supply. The demand for that real estate has suddenly come into tight supply. You have 90% utilization, and therefore the rental rate's going through the roof. And so therefore as the rental rate goes through the roof, it all falls to the bottom line. And so therefore, and the value of that is, well, when you get to the point where you need to build new real estate, what's the cost of that real estate? And so that's a pretty easy to identify number. And if I can buy something for 10 that costs 50, then I'm buying it for 20% of its replacement cost. Now, when do the economics get it to the point where it's worth 50? That's the uncertainty that people aren't willing to invest in, because I don't believe it. I don't know when it's going to happen. In the meantime, we invest in it because I have a strong conviction that it's not that long a time horizon. And when I start at 10 and I'm going to 50, that's a really good return. So therefore, the time period becomes less significant. And now, of course, the company disappoints. I'm holding up my hands. So I got one high, got one low. And what happens is, as it disappoints, which inevitably will, because the situation is not conducive to the supply demand, this is the only one place for the stock to go. It goes down. Doesn't matter that you're buying $1 for 20 cents. It goes to 10 cents. And if it continues to disappoint, it goes to 5 cents. So the opportunity gets larger and larger and larger. Probably the opportunity gets closer to realization because the timeline is changing, because the supply is dwindling. And so therefore the demand returning is an uncertainty. So that's what it is we look at these businesses and understand in certain cases that disparity, and therefore continue to invest as that opportunity potentially gets wider as it doesn't happen in the short term. And so therefore that's, as I said, that's where we've made the most money. In the short term, it worked against us. And then we invested more money when the opportunity became closer to realization and the valuation further discounted.
So you look in a fairly granular way at a company like Tidewater that's been a huge investment for you, and you say, okay, so these guys have 200 and something vessels. These are all these crew boats and tugboats and the like that are used to service global offshore energy companies that are exploring and producing. And then you're like, how much would it actually cost to replace these vessels? And then you're looking at it and saying, and who the hell wants to invest in servicing energy exploration and production companies offshore, given the kind of ESG concerns, right? So is that the sort of analysis you're doing here?
It is. And that's what happened was I was down in New Orleans. We went on a field trip to go see Methanex that owns methanol plants. They were relocating a methanol plant from Chile to the Geismar, Louisiana. So it was a field trip to Geismar. And we're in New Orleans. As long as I'm there, I'm in town. Who else to visit with? And I said, Tidewater. I hate the boat business. It's such a business. But I had nothing to do. So I went to go see Jeff Platt, the CEO of Tidewater, and had looked at it and said, hey, gee, maybe it's different than what I thought. What they've done with the fleet, they've upgraded the fleet. It's newer, but it's still problematic and whatever else. And so initially I didn't even want to invest in it because I've been around the business 50 years. And so therefore, it's not a business that inherently pulled me in. But of course it was, wait a second. Now suddenly it's gone through bankruptcy and I have a balance sheet with no net debt. I have a company that's breaking even at the bottom of the cycle, and I can buy assets for 20 cents on the dollar. This is going to make really good returns. And so therefore, we started to invest. And then the other thing that I've learned from investing in businesses that have no identifiable earnings stream, and therefore the assets are hard to value, and therefore you can buy them for far less than what it would cost to build those assets, would be, as the thesis ends up being right and the supply demand comes into balance and the thing starts to manifest, when the stock doubles, it's probably a better buy than where it was when it didn't. Because what's happening is the supply demand has come and right-sided. The economics are now starting to manifest. The earnings will be there. The valuation replacement cost becomes relevant. And the identifiable timeline suddenly now appears. And so therefore, to put more capital to work, even though it's appreciated, and that's what we've done in Tidewater over the last couple of years. At various points, I continued to add at higher prices because the price to value was still substantially discounted. So when it got to 30 cents on a dollar, and I can now identify in the next 2 to 3 years, it was going to $1. And so therefore, the opportunity now was ripe. And so therefore, to put capital to work. And as a result of that, you end up having a really big investment in something that is really, the right. I guess Munger has the phrase that, there are very few things in life that really work out well. And when you have one of those, you take full advantage of it. So therefore, when these things manifest and the opportunity then comes to fruition, the investment thesis we had now manifests. There's an opportunity to put capital to work on a really great risk reward opportunity.
I was looking at Tidewater recently, and it looked like you had over $300 million in the company. Is that about right?
I have a big investment in Tidewater. Yes. Yeah. Now, truth be told, right? So therefore, if you do look through my public filings, you did see in the last month, I have sold some stock. And so therefore, in spite of the fact that I say, investing is really more predicated on a price to value equation. It's not necessarily on putting together a portfolio and portfolio risk and sector allocations and all that. Say, I'm not looking to offer you a diversified investment portfolio. I'm looking to identify situations that the price to value are substantially mispriced, and therefore there's a great opportunity. You have to figure out how to allocate your own capital that, you've got things in different pockets, but I'm not looking to do that. I'm not looking to replicate that. Instead, I'm looking to identify things that I think there's a huge investment opportunity in it and put my own capital and yours alongside me to work in those things. So.
And we're not really proposing any of the, well, I'm not anyway, using this podcast as ways to sort of propose buying particular individual stocks. It's more to illustrate Bob's way of thinking about businesses, right, and about how to invest and where to find opportunities, and taking advantage of some of these bigger trends that we're seeing. One of the trends that you've been talking about a lot, you quoted the head of the International Energy Agency saying that we're in the first truly global energy crisis. And as someone who's invested in this area for 50 years, can you give us a sense of what that actually means? What we're seeing in terms of demand, not only for fossil fuels, but for renewables?
Again, having invested in energy is, so the first thing is, I'm still in college in the 70s, but in 1974, I went down to New Orleans for Mardi Gras for Mardi Gras. And on the way down, we almost didn't make it because there was gasoline rationing odd and even. So, 73 was the first event that happened when oil went in 6 months from 3 to 12. And so, I had lived through that experience. And then, of course, that decade, and of course, that's what it was in the 70s, stocks that outperformed were energy stocks, oil stocks, because they owned an asset that was in high demand. They had a high profit. Therefore, money follows profit. And so, therefore, they didn't buy oil stocks because they wanted to own oil stocks. They owned oil stocks because they were making a lot of money. And so, therefore, that's where the capital went to. Of course, what happened was, then in 1979, it's the shop falls in Iran. So you've got a second event. And so oil ends up going to 40. When it started at 3 at the beginning of the decade, it's now 40. But of course, there wasn't a supply response. And therefore, places like Mexico, North Sea, all these new places were economic. And therefore, new production came online, supply came online. So the supply-demand balance was met. And actually, the Shah's fall in 79 exacerbated the problem because the price went even higher, even though the world could, with the production it had, could easily supply the demand. Demand was waning because the price was high. So then you have a period of time in the mid-80s where the world could produce 75 million barrels a day and it consumed 55 million barrels a day, 20 million barrel excess. Right. And over time, of course, where we are today is we now consume 100 million barrels a day, not 55 million barrels a day. And the excess supply, I don't think it's more than 2 or 3 million barrels. And so therefore, never have you had anywhere near that tight a supply. Now, we've been fortunate the last 3-4 years, you really haven't seen the impact of the fact that if you lost 5 million barrels of oil, I don't know what we do because it just isn't there. Right. And again, I emphasize, I thought a year and a half ago when the Saudis first announced their ramp up in spending, right? They said, we're going to increase spending 60% and we're going to hold that for 5 years. And at the end of 5 years, we're going to go from 12 million barrels a day to 13 million barrels a day. Well, how do you not interpret that to be Saudi Arabia is a place in which it's a mature oil field? When you spend money that aggressively and you don't move the meter, you're on a treadmill and you're running awful hard. And so therefore, not only is that supply demand really tight, there's not, the rest of the world probably thinks of Saudis they can increase production in huge numbers. They can't. So we're in a very tight supply demand balance in oil today, which I don't think is recognized at all in pricing. And yet is an important backdrop. The other thing is, of course, there's still an increasing demand for energy. And of course, as much as, the concern about the environment, you'd rather not have the case. Natural gas is clearly the bridge fuel that will facilitate how quickly we can build up renewables to be able to supply enough of energy from renewables or battery storage or all of those things, which will take cement, steel, and all kinds of materials and copper. And therefore the build out, that's what I say, the build out of renewables has a really high cost of energy, of materials consumption, materials that are already in tight supply. And so, in our mind, I just can't see how 10 years from now, the demand for copper is substantially larger than our ability to produce copper. And so that's an inevitability. Now, when that happens and how that happens and how it plays out, I don't know the answer to that. But if we're electrifying everything and we want to do all these things, we want to have all these renewables and we want to have EVs, you got to have a whole bunch more copper that we produce today. And you see that, right? Because that's what's going on in the copper markets. The people in the business identify the coming tight supply, short supply, and they're buying each other. So I don't want to start a new mine because the timeline on that is very expensive, uncertain, and the economics today don't necessarily justify it, but I can't turn it on a dime. And so in the meantime, I want to buy the guy who has the copper. So therefore I supplement it. So, PHP's bid to buy Anglo was not efficiencies, synergies, or anything else. Kind of like, I want to own more copper. How do I do that? I buy a big copper producer. So we think the call on materials is a really interesting opportunity for long dated investments today. That's probably not the question you started with asking me. I've done a path someplace.
No, it's an interesting and important point that you make. And just to clarify, I saw in one of your shareholder letters, you said that electric vehicles need 4 times the amount of copper as a gasoline car. And likewise, things like wind turbines consume lots of copper. So part of what we're dealing with here is this tremendous demand for lots of different materials, right? Like steel and copper and nickel and lithium and cobalt and all of these things. Part of what we're dealing, so there's sort of increasing demand for all of these scarce natural resources. And then at the same time, there's mounting pressure to protect the environment. And I wondered if you could put that in a sort of mature, reasonable context, because I think there's so much ignorance and dogma about when it comes to these questions of the environment versus fossil fuels and the like. And as someone who's really actually having to position yourself so that you're able to kind of navigate this tension between environmental needs and economic realities, how do you think about this whole question?
Yeah, it's inflationary. So last September I was down in Chile, and so Finning is the largest Caterpillar dealer in the world, and so they had a field trip, and so we would spend 3 days with them going through their facilities, and at the end of it we actually went to an open pit copper mine. When of course the scale of these things are, we'll have like no appreciation for it. Like you have a copper thing at home, you don't think much of it. So first off, is that those I'm sure everyone's seen a picture of one of those large Caterpillar dump trucks that holds 100 tons. Like the wheels are 8 feet high, and each one of them costs $250,000. Truck's just a behemoth, and you stand next to it, you go up it, it's 40 feet high. Oh my God! Then you go to the open pit mine, and you see 50 of them, like little ants running around the mine, and they get loaded up with rock. And now they have to go up the Serpentine Hill to get to the top of the mine. And they move at a pace of about 2 miles an hour, burning huge amounts of energy, diesel, to be able to move that rock to get to the point. And then eventually you take that rock and you process it, and you come up with 20 or 30% copper. And then you ship that to China probably, who then refines it to make 99% copper, who then ships it to someone else, who then incorporates copper into their wire or whatever else. So the scale and the interrelationship of this and the role of China in that process is like amazing. At the same time, for the copper mine, when I'm talking to them, they say, yeah, we have this copper mine and we're doing this expansion. And fortunately, we have a water desalination program. And because you can't use groundwater anymore. And desalinated water is 10 times the cost of groundwater. And it also means the energy consumption is 33% higher for that operation because of the desalination. And because we have the desalination, there's a guy who has a copper discovery not far from us, and he thinks he's going to develop that copper mine. He's never going to be able to do that because he doesn't have the infrastructure to do that. He doesn't have the desalination capacity. So the fact that we have all those things, but it's going to cost us more money. And then lithium, which is another big product that comes from Chile. The government of Chile says any new lithium projects, we're going to own part of the economics in that project. And you're going to do these things. And Indonesia, in Freeport-McMoRan's copper discovery that they have in development, they were planning on taking the copper someplace else to have it refined. Indonesia said, no. You're going to build a smelter here in Indonesia. We're going to capture more value in that process. And therefore, you're not just going to take that mineral and run away with it. So we're going to take the second bite at that apple, and we're going to build out our economy. So what I think is the demand for incremental new resource, these countries are in a different position than they were 50 years ago when you came in, you paid them some money, you took stuff, and you ran away. No. So what's the environmental impact? You're going to have to do things that are going to minimize the environmental impact, which means a lot more money and a lot longer time to develop these materials that are going to go in. So life is a trade-off. It's not like you do this thing and it's only good. It's kind of like you do this thing and it's good, but you got to do this to get that. And so therefore, I think we're ignoring the idea that but you got to do this to get that. And so therefore, there's an extra process involved. There's an extra burden on the environment, an extra concern about that. And that's going to be mitigated in some way. And that's going to cost you more money. So it clearly is. And now, of course, I'm a Pollyanna. I think everything, works. I see how everything works out well. In my mind, it's really good because one of the arguments in the last 2, 3, 4 years is the South is short of resources and money, and the North's got all these advantages. Well, the northern part of the hemisphere is going to need all the stuff that's in the southern part of the hemisphere. And the southern part of the hemisphere is going to say, that's fine, but these are the conditions in which you will take that resource from me. And this is what I want in return. And so I think that's really good, because that means that that value and that economics start to float to parts of the world that have had more difficulty, haven't been able to capture the value of what they own. And what they own today is in very high demand and increasing demand. And the value capture was going to be significant. And that means in the process, it's going to cost a lot more money to do the things we need to do to build out renewables.
You mentioned this trip that you took to Chile, and I think you were away for about a month, going to Chile and Norway and Dubai and Turkey and the like. And when you came back, one of the things you wrote about was your increased conviction that the US is structurally advantaged for years to come.
Right.
Can you talk about that? Because I think for a lot of people who've been thinking for all these years that it's time for the revenge of foreign investments and that finally that will come good, what you're saying seems to be, no, actually, you really want to focus pretty heavily on the US.
Well, I actually think both of those are true. Because I just went through an example where resource and materials are in the South, and those are emerging markets. And so I do think that emerging markets are going to have an emergence. And so therefore they are the beneficiaries of the continued movement, evolution of globalization out of China. So therefore, I think emerging markets have really good growth in front of them, because they're going to pick up some of that advantage from the movement out of China. At the same time, the appetite for materials are going to be things that also do well for them. At the same time, if we're in North America and we have really low cost energy and we have that huge advantage, that means we're building out all this infrastructure, we're building out all this industrial capacity, and therefore North America will do well in that process too. And of course, a place that's, I think, substantially at risk is Europe, because Europe, right, it is more focused also on the environment, and decarbonization in many ways is deindustrialization, and therefore the movement of industry from Europe to America is definitely something that will continue to accelerate, I think. And so that creates a headwind. There's probably other opportunities in Europe too. I wouldn't be so sanguine about, it's like things look really bad there. So I actually see a world in which, yes, North American markets, and I can't help but think that also is a whole bunch of positives that end up being for America. Now, at the same time, we have a whole bunch of debt that has not come home to roost, and that continues to grow. And so therefore, there's a cloud out there too. It's not just sunny, clear skies ahead. And again, that's probably more like, do you pick the right industry? Do you pick the right company? Because in spite of the fact that America may have other structural issues, these industries are going to be competitively advantaged and probably have pricing power, and therefore have growth and therefore good economics, and start out with low valuations too.
So part of what you've been doing, as we mentioned very briefly in passing before, was investing in these chemical products companies like LSB Industries that are in ammonia and the like. So these companies that in some way embody the competitive advantage of old style US industrial businesses. Is that fair to say?
Well, it is, but I'm looking for more. I'm greedy. I tell you, I'm greedy. So LSB, what they do is in large part, they're making fertilizers, cyclical business depending on, crop prices and all those things. However, to make that, they make ammonia. So this is part of the energy transition. So energy transition is something that is real, will continue to gain momentum, and therefore will call on capital, and part of that process. That call on resources means that's an interesting dynamic. But ammonia is interesting from the point of view of it has three different roles that logically in the next decade it could now have huge increase in demand. The first one is as a marine fuel. So shipping is a huge impact and a big carbon output. And therefore, they're trying to figure out how to convert the engines to burn something other than something that creates CO2. And so there are two identifiable options for that. One of them is methanol, and the other one is ammonia. So therefore, by burning ammonia, when you burn ammonia, you don't produce any CO2. and to produce other pollutants, but you don't produce CO2. So there's a movement afoot. There's plenty of companies who have identified engine capacity, therefore, to burn ammonia as a substitute. There's also in Asia, they're doing test burn now to substitute in with coal ammonia, because when the ammonia is burned, you don't have the CO2, you don't have the other output, the noxious things that come out of burning coal. And so therefore Japan and South Korea are testing that process. And that could be a huge market for incremental ammonia demand. And then the third use of ammonia is it's really hard to move hydrogen. And hydrogen is, kind of one of the holy grails of energy transition if we can get to use hydrogen. But hydrogen is hard to store, it's hard to transport. But ammonia is not as hard. It's still got its own issues, but not as hard. And therefore, you can transport ammonia and convert it to hydrogen. So therefore, it's a bridge fuel to be able to use hydrogen. So these new uses are there. So that's what I really think over the next 3, 4, 5 years. So the end market demand for the intermediate product they make, ammonia, is going to be substantially higher. So there's substantial growth with energy transition. So not only does it have the attributes of, we think, a positive situation where you're going to make ammonia, you make it here in the US, right? Natural gas prices are 2 to 3 instead of 9, or when they were 60, they were 9 here. So you get this huge pricing differential, and that's your raw material input. So therefore you make it for less here. The pricing is set by the European or Asian producers. So that's the pricing power. Their cost structure is such that they make a margin on it. The North American producers make a huge margin on that. And that's a sustainable advantage because our energy costs are lower than theirs. So the fundamental business as is, I think, is one in which there's substantial growth in terms of profitability in the business because you're in the right place producing with a lower cost structure. You're really cost advantaged. But the other thing is there's also an end market demand for the use of the product, intermediate product to make that are in new uses that aren't there. So huge growth opportunities. And as a result, further, ammonia becomes part of the equation potentially. So you have seen, Exxon Mobil bought Denbury Energy, and Denbury owns a CO2 pipeline that moves CO2 for carbon sequestration purposes. And so that's why they get into the business. And so they're going to be advancing carbon sequestration because they own the CO2 pipeline. So therefore, Exxon is looking at, okay, so we're not just an oil and gas company. That energy transition is going to put us into CO2 capture as part of the business. Ammonia looks like it's part of the business too. And so therefore, is there that kind of logic where the integration ammonia companies become something very different and an opportunity for large oil companies to be part of their portfolio of energy and energy solutions?
It seems like a nice example of what you do, where you're looking at a market that's become kind of consolidated and that's transformed, and at a stock that's cheap and something that's off most people's radar, and something that is aligned with these sort of big macro forces like
Right.
the U.S. strength in energy, low cost energy, and the like. It feels like it embodies a lot of what you do.
Right. We think there's a lot of ways to win. Right. And there's a entry point of low valuation too. So, yeah.
When I ask people on X, formerly known as Twitter, whether they had thoughts about questions I should ask you, one of the questions I liked most was from Joe Costa, who has this terrific aggregation service where he sort of curates lots of the best resources on value investing. And he wrote to me, one of the things that always strikes me about Bob is how kind he is and how he exemplifies what Adam Grant calls a giver. From what I've seen, this is pretty widespread among both younger professionals and college students who come in contact with him. So I'd love to hear him discuss his views on giving back via his time and knowledge to younger generations and why it seems to be so important to him. And when I looked at the philanthropic stuff that you and your wife Suzanne have done over the years, it's really striking to me how much is related to kids and education and the like. And I wonder if you could just talk a little bit about what your to comment on Joe's observation that the giving back is important to you, and there seems to be something distinctive about the way that you think about it.
Well, first off, full disclosure, I know Joe and I know Joe well. So this is a question from a friendly person too. So he's just giving me an opportunity. He's throwing me the fat softball here. Let's see if I can at least get a ground ball. I think it's really interesting. I think, and of course, it's fulfilling for me. My experience, like when Isaac graduated college and said we should invest in Asia, and so I said, okay, let me go try that. So I would go with him, and I, ended up for the next 6 years doing all these trips to Asia and visiting all these companies, and the information that you get, as Friedman said, the world's flat. That's why I say it's not deglobalization. It's just the evolution of globalization. It continues to move places. And so my appreciation for that was colored by the fact that I listened to Isaac and said, okay, let me humor him. This, maybe I'll learn something. And of course I learned a lot. So therefore in the process of, talking to people, you do learn a lot because they ask different questions. They go different ways. They do different things. So therefore there's a value to that clearly. And there's also a value in terms of, giving someone who's hardworking and, is looking to figure out how to advance their situations in lives and be able to help them in that process is, because it's, opportunities are somewhat limited. So the extent that you can give opportunities to people who are anxious to do things to improve, clearly that does something. And, clearly there's a value to that. It may all go back a little bit to, so when I was in 6th grade, 7th grade, then I went to Catholic school. So the nuns used to raise money for the people in someplace in Central America. And so therefore there was a competition that they would fit, so therefore there were 46 kids in our class, right? Half girls, half boys. And they said, okay, who's going to give more money to girls or the boys? And so Maria Napolitano used to always give money, but I used to give money. So there was a competition they set up between us. And at the end of the day, my family came from a modest neighborhood, but we actually had reasonable money. So when I describe my situation, growing up with the family, and there's 9 of us in the house and there's only 1 bathroom and that. And so someone said to me, oh, so that's why you're successful, because you're driven, because I was in a difficult environment. I said, I love my childhood. It was wonderful. Because we had more than most. The idea that I could share that with people made me feel really good. Sorry.
No, that's lovely. And I saw actually I think you got a lifetime achievement award from Pace, right, the college where you went, and they referenced that 7th grade competition and
right,
and said
right,
that it kind of they said participating in that contest combined the joy of winning with the joy of giving to those who had greater needs than us.
right.
They were quoting you and talking about kids in Central America needing food. Well, I really didn't need that extra pack of baseball cards.
Right.
It seemed also that one thing that was very powerful for you about giving to Pace was the fact that, as you put it, a lot of the people came from these immigrant backgrounds, and
Right.
and so it was more obvious that you were really benefiting people who, I mean, I guess in some ways not dissimilar to your grandparents' story, right? Of your grandparents coming from Italy and having to make a life here.
Right. So, and of course, so my college is Bucknell. And so I do give money to Bucknell because Bucknell did give me a loan and some money when I was there. So I owe them. And of course, everybody owes money to the schools they go to, because the reality of it is, right, when you get charged for tuition, it's less than what it costs to educate you. So there really is a gap that you've been the beneficiary of. But Bucknell also is a place that has a bigger endowment and educates generally people from a higher socioeconomic background, as opposed to Pace is, it's a different input group. And so the people who go to Bucknell probably will do whatever they're going to do in life anyway. You don't change the direction of that too much. The fact of the matter is, the people who go to Pace and then get a college education, potentially you have impact. And of course, Pace is a place that has harder numbers in terms of, what's the graduation rate and where it is, and it isn't as good as other universities. Of course, you start with a population that's, kind of a more disadvantaged. And so therefore the likelihood that you're going to come up with the same graduation rate of what Harvard's going to come up with, of course you're not going to do that, because that group inherently has all these advantages they come in with. That's not the situation with Pace. And so that's why I'm much more actively giving money to Pace, because it really changes people's lives and it has impact, as opposed to, our endowment's bigger than Colgate's and that's wonderful and whatever else. So,
Another great rabbit hole that I fell down over the last couple of days while I was researching you was I was studying this amazing not-for-profit that your wife Suzanne runs and that you've been very involved in helping to fund, which is called Med Shadow. And it's
Right.
really kind of important and impressive. And I wondered if you could give us a sense of what it is and what, also what motivated her to do it, because it's kind of an amazing story of how she turned a very difficult situation into something where she's really had a profound impact.
Right. Well, that's what it is. So she's had personal experiences that, put her in the position to therefore, think about this issue in many different ways. And so therefore to have the ability to have impact on it and potentially change things is, critical and positive. And that's what we're here for. If we can do good things in the process, that's great. And that's what it is. Pharmaceuticals are, I think it's number 4, number 5 in terms of, largest causes of death in Americans. And that's not misuse of drug, but those are prescription pharmaceuticals, right? That's not heroin that you got in the corner that you get an overdose and die. So, it is a problem. And therefore, thinking about, because that's what it is, right? We live in a world in which, we're looking for the easy way out. And so that's what, post the financial crisis, the government decided the easy way out was I'd make interest rates 0 and therefore I'll help everybody. Instead, it's effectively the same as my wife's situation is, well, you kept giving them medicine, get them off the medicine. They need to get up. They need to exercise. They need to, diet and exercise are really the solution to many things. But yet there's times when you need medicine. So therefore you need to do that. But you need to be cognizant of what's my side effect of those things. And especially as you get older, there's multiple medicines that you're taking. And therefore the impact of those and how they interrelate is kind of complicated. So these are, but of course her situation is different, right? Her mother took a drug that therefore, caused her infertility. So therefore it's a critical part of her life. And then when our nephew came to live with us when he was 12, he didn't come because he was the ideal child. He was a rambunctious 12-year-old.
Yeah.
And rambunctious 12-year-olds in a Catholic school don't necessarily jive. And suddenly Ritalin is the thing for him. So my wife went to go see the doctor and talked about Ritalin and said, well, what are the side effects? And they said, oh, there's no side effects. If there were, we would know. And she didn't feel very comfortable with that as an answer. He's a prepubescent child. We're going to give him a drug. He's going to be on it for, an indefinite amount of time. That has to have some kind of impact. So he didn't go on the drug. We were fortunate to be able to give him more money to the school. And they said, okay, he doesn't need to go on the drug. So she had that experience too with Dan, and when he came to live with us. And so therefore, that's another experience that she's had. And from Med Shadow, she's done other things too. So she's involved with the FDA. She's actually on advisory committees, and therefore regularly called down as the drug safety component on hearings with new drug applications in terms of what are the side effects, what are the medicines, should we approve this, how does this all work? And so therefore, she has that kind of input and an additional value that I think that she derives from that process, right? Because all these things we do, we get benefit from it, right? This is just a give things away. We see things, we hear things, and we have appreciation for things, and we learn stuff. So therefore, there's a lot of learning from that process, and learning those things is really critical, important, and potentially make us better contributing and making the world not so bad.
I listened to her on a podcast yesterday talking about lifestyle choices and the like
Right.
to deal with diabetes or pre-diabetes, and she's a very remarkable woman. I mean, I don't need to tell you, but I just wanted to sort of honor her. I mean, she took this very, very difficult situation where she'd been given, her mother had been given this this medicine DES that was kind of, I guess it was like a synthetic estrogen drug that was supposed to help people avoid miscarriages, but ended up having tremendous side effects for millions of Americans. And she's turned it into this amazing thing where, so obviously there's this not-for-profit Med Shadow, which focuses on this idea that medicines have this shadow that follows you around. And so it's not nihilistic in any way or hokey. It's like saying, no, you need to understand the side effects so that you can make mature, sensible decisions. And so I think it's a really important subject as we look at things like Ozempic and stuff like that, which I will keep thinking, God, should I be one day just giving up on controlling my diet and take Ozempic? And so she's great at highlighting that. And then, as you say, she became the lone consumer representative on this FDA advisory committee on drug safety and risk management. And so that's an extraordinarily important role. And this kind of made me think, you mentioned right at the start of the conversation, you were talking about how your father dealt with a loss of eyesight, and you've seen your wife, Suzanne, deal incredibly with the challenges she had with infertility and with your nephew and the like. And I'm wondering what perspective that's given you on how to deal with adversity, on how to deal kind of wisely in the course of a long life with the things that don't go our way.
So it's amazing. I always kind of I realized that I'm not as introspective a person as I really should be. So for example, my dad, we never really appreciated the fact that his eyesight was so impaired. Now, my mother was a critical element in making that less transparent to all of us. So we were, in many ways, almost sheltered while we lived with him, that he had these issues. So, we really kind of didn't see it. And we didn't, and then there's my shortcoming. They didn't delve into it and say, Dad, what are these things and how do they really affect your life and everything? And so, I always regret that I have today that I didn't have those conversations. So to a certain extent, the way, and there hasn't been great adversity in our lives. I'd say we've been amazingly fortunate in so many ways. And so therefore, occasionally there's a little bit of wrinkle here and there. So you deal with that, so those are opportunities. And so as I joked when my nephew came to live with us when he was 12, I said, Sue, this is perfect. I said, he's already, had some issues here. So like, it's a win-win for us. Either, he's got some issues with, and that's difficult. Then we can say, well, it wasn't us. And if it turns out okay, we can take the credit. So
when you look back on your own life and you think about how successful you've been since you got that C in your accounting major,
right.
How obvious is it that there were certain qualities that you had that helped you succeed? I remember Mario Gabelli talking about you and using his phrase about PhDs, that he always looked for people who were poor, hungry, and I can't remember what the D was.
Driven.
And exactly. But he changed it in your case from poor to passionate. And you've talked about passion as being the thing that you look for when you're hiring. Right. When you look back, like, what do you think it is that enabled you to outperform that's kind of clonable for the rest of us?
The successes we've had have been the ability to, the behavioral advantage of being able to tolerate a loss. So that's what, one of the famous things in value investing psychological is always the concept that losing hurts twice as much as winning, or, whatever the 2 times, 3 times that differential. And the fact of the matter is the losing money doesn't bother me and hasn't bothered me somehow. And so the opportunity of being right, which is, making money, but it's not necessarily making money. It's really, I think, more like being right. And so therefore looking at things and kind of getting a differentiated view and supporting that and coming to conclusions that are different than others it's a great puzzle. So it's it's a personal pursuit that happens to bring along with it a bunch of money if you do it right too. So that's the outcome of it, but I don't do it for the money. I do it for like the enjoyment of it and the fun of it. And if the process of I lose money in the meantime, of course, I have other people's money that I'm losing too. And then, that is difficult, but, I've been fortunate they stay with me. So therefore, at the end of the day, there's a mark to market, but there's not a loss in it. So it's worked out well. And so I think the ability to tolerate disappointments with the idea, like, well, wait a second, what's the idea? Is the concept and the investment thesis still there? It's still correct. And if I'm right now, the fact that I was wrong, it's even better. So those psychological things, I think, have been critical in terms of being able to stay with investments and things that over time have worked out extremely well, because we bought them for a fraction of what those things were.
As I see it, there's a kind of emotional and psychological fortitude that's been really key to you, but it's also combined with the fact that you got very lucky very early on in getting these really robust principles from that kind of Graham school of investing. And you had this this really essential thing, which is that you actually had the technical tools from your accounting background that you knew how to value stuff. So when you were losing money on something, you could actually see what it was worth. So you had something to kind of hold on to, which reminds me of Joe Greenblatt saying to me at one point, like most people just should be indexing or outsourcing to someone else because they just don't actually have the tools to analyze something to know what a business is even worth.
Right. But again, the good fortune that I happened to fall into that job because I did get to see that I thought I was going to get. The opportunity at the time, those things were kind of like, that was really random and good fortune. That's all that was. I could have been someplace else. I worked hard at Bucknell and got a B or an A and got a job for a big 8 accounting firm and be on a very different path today than where I was. Another critical piece of the success has been the fact that when my wife and I married, she had a reasonably good job, and I didn't make money in the business for the first 10 years at all. And so therefore we didn't spend money. So therefore we had a very modest life that we lived in terms of how much we spent. And so therefore I could work for 10 years and not really make much money at it. Most people don't have that capability and capacity. And so therefore there are so many things that have happened in my life that have been good fortune.
Do you feel in some way like you've been taken care of, or do you feel like it was? I had this discussion with Bill Miller over dinner a few weeks ago, and I said, do you feel when you look back and like you wound up, at Legg Mason with a particularly great mentor and stuff? Do you feel like it was luck, or you feel like you were being taken care of in some way by a greater force? And he sort of thought about it. He said something about, well, according to probability, there has to be a luckiest person and an unluckiest person. And his wife was sort of like, I tend to agree with you, William, that, maybe there was something more going on. And I wondered how you, like just your personal sort of temperamental or philosophical or spiritual views, whether you feel in some way like it was all just random or whether you were kind of somehow blessed by this whole process.
I've been blessed by knowing people that I've known.
Yeah, that's been a huge gift. I look back, it was amazing when I looked back on your career and I thought even, your professor was it, Mr. Pastorino, like if you removed one piece of the puzzle, to Anthony Pastorino, the professor back at Pace, and if you removed one piece, the path could have been totally different.
Well, that's the way life is, right? All these things, one change would have been a different course in life. And, had I married a different person, and, one of the things is that we couldn't have children. So the fact that we didn't have children, that's expensive. So to be able to not make money for 10 years time and to have children, well, that's a very different economic equation. So therefore my ability to have kind of persisted would have been very difficult, if not impossible. So each one of those things is a random thing that all comes together that kind of makes the outcome where you end up. And there were other outcomes that probably would have been good outcomes too, but they would have been different outcomes for sure.
Yeah, it's kind of humbling. It fills you with a sense of wonder at just the complexity of it. Yeah. Anyway, that's a lovely note on which to end. And I just really enjoyed chatting with you. And I was amazed as I look back on your career at just how remarkable your results have been over a very long period. And so
Thank you.
I'm happy to have people pay attention to you because I feel like I don't feel people have quite realized how extraordinary it is what you've achieved, and you've done it in a quiet, low key way without any bombast or braggadocio. So it's been a pleasure to get to chat with you,
William. It's been great to have a conversation and just chat. It's been a very relaxed environment, and thank you so much. And I enjoyed it, and I hope people weren't too bored by the conversation.
No, it's fascinating. And next time we'll do it over a drink in New York City. I hope.
Okay. Sounds great. Thank you.
Thanks so much.
Bye-bye.
Stay well.
My pleasure. Thank you.
Well, I'd be very careful of some of your software companies and a lot of what's in the ARC portfolios. where you don't have profits, and you may not have profits, where almost everything has to go right, yet you're paying ridiculous multiples to sales. Always be careful of paying big multiples to sales for profitless businesses.